Hey everybody, this is Mitch Ferraro from F Street. I'm super excited to be here today. Thank you for everyone joining us. Hope everyone's having a great day out there. I'm here with our owner and founder, Scott Lurie. I'm the investor relations manager here. I thought it'd be great to get Scott on today because most recently we've been getting a lot of inquiries about what is going on with these tariffs and how it's affecting our private debt fund, the F Street business. So I'm very, very fortunate to get some of Scott's time to talk through this and have Scott kind of talk to us a little bit more about what he feels is going on in the marketplace and again how that's affecting F Street and our different verticals that we're in. So Scott, thank you so much for the time today. Really, really appreciate it. Kind of just maybe just jumping right into it. What are you currently seeing with the tariffs that are happening right now? Again, that's specifically a lot of investors of ours are asking that question. What's going on? How are you guys doing it? How are you guys handling it? So I think this is a great opportunity for us to kind of get ahead of that and kind of talk to our investors directly.
Yeah, that's great. It's great to always get to chat a little bit. We've received countless inquiries specifically about the tariffs, and I think the tariffs is really a culmination of people's fear as it relates to just the market volatility. So tariffs, as you know, we don't import any goods. We don't have any product that's directly that we have implications for tariffs of, right? So we're a finance company, but our clients potentially do as they buy items through various different channels. So there are implications to us, but I think, overall people's fear is what's described today as a tariff, right?
Yep.
Tariffs been around forever, but tariffs are what are causing people a lot of individual concerns as it relates to their investments, and it's certainly warranted. As I said, we don't have any direct implications to tariffs. So when people say tariffs, how do they directly impact our business? I would say there is no direct implication, right? There's tertiary implications as it goes around our business and it goes around our world, and that's absolutely a real fear. Everybody, fortunately or unfortunately, now has access to media, and media shares different fears. And as they say, if it bleeds, it leads. And the reality is that if we can instill fear, it's good for the news networks because you're coming back tomorrow to hear the next bit of news. I watch CNBC 24 hours a day, 7 days a week. I'm always marveled at how they have things to keep saying because they say the same things, but I still watch it. So here we go. So I look at tariffs as the overall general condition fear, and fear of the marketplace is a real concern for people. What really happens if we want to go back out 30,000 feet, what really happens is the tariff implications and the volatility in the markets really impact the banking industry, right? The overall industry. And so when you look at the overall industry, I go back to when the crash happened in 2008 and 9, and without getting too much into that, or you look at what happened when the Frank Dodd Act came into place, these implications rattle the banking industry, right? They take what is traditional layup loans for lenders,
Right.
and they go on pause, right? Banks go on pause. So what has that pause or this fear done for F Street and its business? Generally, in good times, we do good. When there's volatility in the market, we do better, right? Investors who are professional investors, seasoned investors, there's millions of people. There's an industry of millions of people that are in real estate investments, real estate investors, and capital is a required part of this.
Yep.
So if your normal channel of capital is, call it traditional banking, and traditional banking is starting to, put some roadblocks in because they're afraid, or their board is afraid of the tariffs or what the implications are to the world, it creates more opportunity for F Street. So here's what we're seeing today. We're seeing continued demand based on application counts. Last month we had I think 380 applications. We're on pace for more in the month of April.
Sure.
And that's April 2025. We're seeing a huge uptick. We're seeing larger loan amounts coming in with very good validity to approval of them.
Yep.
So we're seeing traditional loans that would get approved at 65% in customary traditional fashion at lower cost of capital coming to us for opportunity to either refinance or to help with acquisition. So we're seeing that. And we're seeing our traditional business, right? Our normal business continue to navigate, right? It's still moving. And I think it'll continue to move. I think over the next 12 to 18 months, as this news story fades off and we get into another news cycle, and I don't know what that news cycle obviously will be, I think we see the opportunity for us to continue to finance deals. We're on pace right now to exceed 2024's total income, total loan amount by material amount. I think, overall on a global level, business does better as an alternative financier with a volatile market, and we're in that volatile market right now.
Yeah. And I think one of the best ways to kind of look at that too is like, as these kind of times come up, money dries up, which now we're seeing more applications come in because people are still finding deals out there. There's still a lot of deals out there that people need financing on. So F Street kind of becomes like this solution for investors.
Yeah, right. I mean, the real estate investor, because there's a tariff that hit the market, isn't
Right.
like, hey, I'm out of business today. They're doubling down. They're making sure their business is happening. The problem is their outlets for financing options just goes down, right? If you had 5 options yesterday, tariffs, the volatility, or tariffs, the volatility as a result of tariffs, you've got 2.
Yep.
You don't have 15 anymore. And so that volatility continues to allow investors to find us through our broker network, through our own SEO, and through our own marketing channels, and then just repeat referral borrowers that are like, hey, I can keep going.
Right. And I think it's important to let our investors know, or people that are thinking to invest with us, as we're starting to see these more applications come in, we're still going through the same type of underwriting processes that are making sure that these deals are good deals still.
Absolutely. I mean, so our business model is very, very driven off of process, right? We have property valuation, we have underwriting. We at no point, because of any external circumstances, does any of that change, right? We are still a disciplined lending institution. We're just open for business, right? We're looking for opportunities to make solid investments. So we continue down that road. So absolutely, our method of madness as it relates to underwriting a loan, whether it's today or it was in December of 24, or it's going to be tomorrow, is always the same and always improving and getting better rather than changing. We just are seeing different opportunities, and those opportunities are in addition to our current and normal course of business.
Right. Right. And I think it's important too, as well, that can let investors know that, like, hey, we're still in business. We're still doing very, very well. What do you see as being the business owner, what the next 6, 12, 18 months might look like for F Street?
Yeah, Mitch, that's a really interesting question. Thinking through what's going to happen, if 2025 continues to develop as it has in the first quarter, what I anticipate seeing is larger loan sizes, more opportunity, lower leverage across the overall portfolio, and a little bit more selectivity on our behalf of what we choose to do and choose to not want to do. But I see demand remaining off the charts, right? When it's interesting because the outcome of these various turbulent times, not everybody loses, right? If you're in a down market, there's someone in the up market, right? There's someone who's on the opposite side of the down as the up or the put or the call, right? So, we have people that are out there finding opportunities. We will see, you asked the question and I kind of answered the short term, but we will see, in my opinion, you'll see opportunities that'll come from banks looking to sell distressed or create distressed loans. If you remember 6 months prior, right, before all of this talk ever even came out, there has been a massive liquidity issue in the banking industry, right? Liquidity has been a problem. It's not new. This is not a tariff-based issue. This is a liquidity issue. So we continue to have opportunity. Now, the liquidity issue, I think, is a little bit more amplified because people are just like the unknown creates lenders, bankers, boards of lending institutions to just say, pause, right? Because when you're in the money business, you can turn on and off the switch, right? We're open, we're closed, right? That's banks make money by lending money. They don't make money off of CDs. They don't make money off of deposits. They don't make money off of servicing your checking account or the $20 fee they're getting or the NF. They make money lending money. And so, but they also have the ability to pause when they need to. They're driven by boards. They're driven by various different aspects. And so, I watch a lot of different outlets. I see a lot of people concerned. I look at it as opportunity on behalf of our lending company to take advantage of select deals that continue to come our way.
Yeah, and I think too, like as we're seeing more recently, there's so much volatility. We're losing thousands of points in the stock market. We're gaining thousands of points in the stock market, and a lot of people can feel that volatility. They're saying, "What do I do? I don't know if I want to be in something this, volatile." For investors that are with us or they want to come and get on board, like what do you think is like the best way to tell them, like, hey, you know what? Investing with us at F Street, because to me, being invested myself in F Street, like I know I can sleep at night. I know that I'm getting a consistent outcome. I know that the team that's a part of F Street is the right team that I know that I can trust and feel good at the end of the day. What can you tell investors to say, hey, you know what? Investing with us is this reason is why it's a good opportunity for you.
Yeah, great question. So the answer is this: our income, our revenue, our business model is not driven off of the stock market. Yes, I watched it go down to epic levels. You remember the days of the dot-coms when I was sitting somewhere and watching Netscape go to the moon and these crazy, you remember these days. They last in your head. I'll never forget the 2,000 point drop, only because it's historic. At the end of March, every one of our investors received their distribution. At the end of April, every investor will receive their distribution, as they have for the last 16 years. It's not like something is coming into our world and saying, hold on a second, no distribution. The fundamentals of our business are as strong as ever. The demand for our product is strong as ever. Our income is as strong as ever. And we continue to make distributions. So when people say, I always say to people like, hey, you're so crazy. Like, what caused the stock market to go down and then up and then 2,000 points and 1,000 points, then up 1,000? In the last, call it 12 days, we've had one of the worst performing days in the stock market. I think we've had one of the best days since 1992. And along that whole duration of 10 days, our business has never changed. Nothing's materially changed in our business that gives me any pause to say, holy smokes, we're not going to be able to make distributions. Nope. End of March, for all the investors that got their distribution, expect it. You're going to expect it in April. We have nothing that's stopping you from doing that. And if you were a retiree or soon to be a retiree and your 401k is on the verge, we've got a flawed system. At the end of the day, our system is crazy. And people that migrate to alternative investments, so long as they're diligent about their migration, will be the next, I don't want to say set of millionaires because that's not the right verbiage, but will be the next set of investors that will retire with comfort versus I have all my money in my 401k. I've worked my entire life for it, and you lost 22% of your money because you were only in these 5 stocks and they're down 22%. It's not really fair. It's not really what the system was set to do. And yes, you enjoyed the upside, but to get kicked in the teeth because a president chose to lead as delivered, right? These are not new threats, by the way. The tariffs, the only thing that happened was the tariffs happened, right? The threat of the tariffs has always been there. And then at midnight, the tariffs connected, right? And my personal feeling is we all knew they were going to be short-lived. This is really maybe a war against China to say, hey, China needs our economy more than we need their economy. But I don't know. I'm not an economist. But all of a sudden, on yesterday, Sunday, right? Tariffs on Apple and Nvidia shares are now suspended. Okay. I mean, it wasn't sustainable at the end of the day. So the reason I say it is if you're looking for sustainability and comfort, you can call Scott and Mitch and ask how your investment's doing. You can email me and say, what are the tariffs doing to your business? And I'm going to respond. We got a lot of inquiries about it, so we're putting out a little bit of a message to everybody. But the reality is, you have someone to talk to, right? And maybe that talking to is comforting. Those emails are therapeutic. There's nothing more therapeutic than getting your distribution at the end of the month. Nothing. Nothing will comfort you more than saying, "Oh, it's there," right? And so I've relied heavily on that for the last 16 years to make sure that we can deliver consistent returns. Our business is not driven off of a single loan, two single loans. There's 500 loans in the portfolio, and I have no reason to create any pause for anyone under the say as business continues to remain strong. We have figured out a great widget, our business, our PDF, to deliver above market returns. And I encourage everyone to evaluate and participate in alternative investments. And if F Street's your home, thank you for being an investor for us, because I'm confident you'll get your distributions as agreed.
Yeah, and I think a big part of this too, Scott, is that I think over the past, year or two, we've done a really good job of getting in front of our investors and helping them educate them and showing them what investments look like, whether it's private debt fund or new construction build development, industrial acquisition, industrial development. We get in front of our investors and we help educate them on what the investment looks like, because at the end of the day, they have to do their own due diligence, right? They have to feel good of what they're investing in. A lot of investors, right? They just have something in a 401k and they have an advisor that's pushing their money around and kind of figuring out what to do. With us, we really try to make sure that those investors know what they're getting into. They have an idea of what the investment looks like and what distributions look like. And I think that's a good kind of leeway into maybe some of the equity stuff. Like if you are in our private debt fund and you have seen some different opportunities from us, from industrial to new construction, multifamily, what are some of those things that investors can expect if they want to get into a different vertical with F Street? They're with us already, or maybe they're looking again at us for the first time. Explain some of those things and maybe touch on some of the tariffs as well with some of this other stuff that we're doing on the equity side.
Yeah. So another great transition, which so we, as a three-pronged alternative investment company, we focus on our private debt fund. We have industrial investments; those are both ground up as well as acquisition, and then we do the same thing for multifamily, ground up and value add acquisition. Right. So we're alternative investments, and we're real estate focused. Right. That's it. That's where we have found our calling, and we've been doing it for 20 plus years, and we have always delivered, always. So when you ask about the transition, we released a industrial deal on Friday. 5 hours later, the incomplete equity tranche for that $2 million has been full and oversubscribed. Of those investors that invested in that, they came for several reasons, right? They came for mostly the immediate cash flow. They came for Some of the more sophisticated ones came for the cost segregation or the depreciation they're going to earn as a passive investor to offset passive income. And of the investors, of the people that invested in it, zero asked about tariffs. Zero. Everyone clicked subscribe, filled documents, because the market was in an up state. Maybe it was because it was Masters Friday. I don't know what happened, but it just grabs different attention levels. When you look at the true investors, right? Where does all of the money move? It all moves to multifamily as a general segment, because that's been the most resilient market for not 5 years and not 10 years, but like 30, 50 years. There's a housing shortage in our country. They say 4 million units. I don't know if it's 4 million or not, but it's a lot. And people go there. The challenge with it is it's not immediate cash flow. It's invest and wait, or invest and return 2 years from now. And so it takes more time for those investors to recognize their values. And so it takes the investor to invest those money with money that is not immediate need for return, right? And so you take PDF pays the month you invest, you get paid. Industrial with cash flow pays the same day. Multifamily value add pays the same month. Ground up industrial, ground up, takes a little bit more time. Bigger risk, bigger reward. It just happens, right? IRRs are in the 20s. You're getting a better rate of return. It just takes time to get there. And so So whether you're evaluating it, I always push people to go back to the money tree when you're planting them, right? Plan your future. If you don't need money for 7 or 10 years, let's start planting those trees today. In 10 years, you'll be thankful because you'll be invested in 30 deals. If you do a systematic approach of a unit, whatever your unit is, that you want to invest in every single deal over the next 10 years. And as you do that, some will start trickling off, some will sell, some will refinance and pay you back. You'll have all of your money out of these deals, and you'll probably be using the same unit from the first one into unit year 3, right? So I encourage everybody to do that. If people could just do that, they'll be very wealthy and generational wealth, and you can pass that on to your estate, and you can do a lot of great things there. So evaluate the following. When do you need cash flow? How much investable cash do you have today? And what is your long-term plan? If your long-term plan is to get the highest rate of returns and you don't need cash flow today, ground up always will be the winner because we're building value. We're creating the spread. It just takes us time to create the spread. If you're buying existing cash flow, you know exactly what you're getting because I can project based on the income that I have exactly what you're going to earn based on amortization of the loan, the cash that's coming in, the rent increases, the management of operating expenses, etc. And then the PDF is steady Eddie, right? 10% return. I can sell that to anybody. And when I say sell it, it's just easy for you to understand. You get paid 1/12 of 10%. So easy. And that's how it was created, just to be easy. It's an easy, steady investment. That's why we raised $30 million in 2024 off of it, which was $6 million above average, and above expectation. And we're continuing to drive. So all of those are great options. Alternative investments reduce the volatility in your world. You didn't see the stock market go down and your alternative investments go down. They didn't. They just didn't. I can promise you all of the investments we had, none of them went down. So I hope you consider investments in alternatives and consider F Street.
Yeah. Well, Scott, I want to just thank you for your time today. Really, really appreciate it. Anyone, if you are going through this and you have questions or things are just going through your head, you can always visit our YouTube channel. You can just search F Street on YouTube. A lot of our different educational webinars are on there about the different developments. You'll also see stuff on there about the PDF. You can always reach out to me, Mitch at fstreet.com. Scott is always available. It's one of the things I love about Scott. My guy is available all the time. He will talk to investors until I think he dies. So it's really cool that he becomes available for our investors like that. But again, everyone, thank you for your time. Really appreciate it. Again, if you want to reach out to us, please do. We thank you if you are part of any of the investments that we have here at F Street. And again, Scott, thank you so much for your time. Really appreciate it.
It's always great to be here with Mitch. And thank you to the investment community for obviously being part of our world at F Street. Thank you.